Morning. Today we're going to talk about risk balancing. I'll get into more detail what that means here in a couple minutes. The outline of this presentation, I want to talk a little bit about sources of risk and how risk balancing fits into that. I'll address how that relates to 4 basic business questions, and then introduce the concept of risk balancing, which has been around for a couple decades at least. And then talk about risk balancing from a short-term perspective, where we'll focus on liquidity, and also from a long-term perspective, where we focus on solvency and business risk. Before I get too much further here, I've got some definitions in some slides here. Let's just talk in general about what I mean by risk balancing. Risk balancing is this idea that we have business risk that's coming from business decisions that we make on the farm, like diversification, purchasing crop insurance, these kinds of issues, and we need to balance that against financial risk, which is primarily related to where we're at from a liquidity standpoint and where we're at from a solvency standpoint. The idea here is if we have more leverage, by definition, many people are going to want to reduce their business risk by diversifying, purchasing crop insurance, making decisions like that, changing their marketing plan so it's less risky. Conversely, if you have quite a bit of business risk, let's say you're involved in cattle finishing. In the United States, that tends to be a fairly risky enterprise from a business risk standpoint. And so if you're involved in cattle finishing, you might want to reduce your financial risk accordingly so that you kind of balance this business risk and financial risk. And so that's what we're talking about today. It's a fairly simple concept to understand, and I'm going to go through a couple papers that talk a little bit more about risk balancing from a short-term and a long-term perspective. So we have many sources of risk. We don't need to get into detail here, but the business risk is your production risk, marketing risk, legal risk, human risk, which is related to HR policy and employees, and then we have our financial risk, which is of course related to short-term and long-term debt strategies. There's also a third category that we talk quite a bit about in the Center for Commercial Agriculture that's becoming increasingly important. If you have questions related to strategic risk, by all means, I can address those at the end. But strategic risk is the sensitivity of the strategic direction and the value of the company to uncertainties in the business climate. In essence, strategic risk is related to making the wrong decision. Did I decide to get into organic crop production, for example, in too big a way? And because I made that strategic choice, that completely changed my risk, and I went a little too fast, a little too far, a little too fast. And so that's what we mean by strategic risk. It's related to the strategies that we pursue, long-term strategies that we pursue. Obviously, strategic risk has elements of both business and financial risk. 4 business questions that we talk about in finance webinars. This is not a finance webinar, but we typically address these in finance webinars or finance training. Are returns adequate? How liquid is the business? How is the business financed? And how efficient is the business? All of these are related to risk balancing. The first and the fourth are related to business risk. So are returns adequate? That depends on what we're actively engaged in, the risk management strategies that we've decided to pursue. How efficient the business is also related to business risk. If we have fairly low profitability, that's going to have an impact on our business risk. And then the second and third are related to financial risk, or the other end of the equation. So first and fourth are related to business risk, second and third related to financial risk. So the general concept here is we have this business risk, which is related to the variability of the farm's return on assets. So we're focusing on return on assets here. That depends, of course, on what we're invested in and our mix of assets. Financial risk arises from the financial claims of our farm's creditors. And so we're trying to balance these risks. So let's talk a little bit more about business risk. Risk associated with production decisions, marketing decisions, business organization, transition planning, personnel decisions. You get the idea. Examples of business risk choices that that become important and really dictate that to some extent what our variability in rate of return on assets is going to be. Our diversification, how efficient we are. We've found in the U.S., and I'm sure that's true in Canada and elsewhere, that farms that are very efficient from a cost-efficient standpoint really have a lot less business risk, particularly business risk if you measure it as downside risk. And so efficiency has a huge impact on business risk, and it also, of course, impacts on how much debt we can take on. If we have a farm that's very efficient from a cost-efficient standpoint or a technical efficient standpoint or both, that farm can take on more leverage and can have a different liquidity situation than a farm that's not efficient. Marketing plans also fit into this. Technology adoption also becomes important. Obviously, if you're very aggressive adopting technologies, that's probably going to lead towards having more financial risk, and so that also can change the balance between business and financial risk. Also, how we transfer risk, whether we're involved in contracting. In the U.S., we have contracts for laying hens, turkeys, broilers, pork, but we're also starting to see more contracts for some crops. They're not necessarily the same types of contracts that we've seen for livestock enterprises, but certainly contracts for crops are becoming more important in the U.S. Also, crop insurance. I was talking to somebody earlier from Canada, and they said you also have crop insurance. I believe it's called agri-stability or something similar to that. And so one of the ways we can transfer risk is crop insurance. And quite frankly, if we didn't have crop insurance, we would really have to rethink our liquidity and solvency positions in the U.S. and probably Canada. And so that's very critical to balancing risk is this whole notion of crop insurance. We do have some livestock insurance in the U.S., assuming you have something available in Canada related to livestock insurance, but that's not near as common as the crop insurance. Also, another very important source of risk that may increase business risk is transition planning. That may also impact financial risk if we have to borrow more money to bring on another family member. Financial risk, as I indicated earlier, encompasses those risks that threaten the financial health of the business. And so there's four basic components. We won't get into the weeds here, but cost and availability of capital. We'll look at sensitivity of financial risk and total risk to changes in the interest rate. That's something that's on the minds of a lot of people in the U.S. as we see the interest rates slowly increase. The ability to meet cash flow needs in a timely manner is also a very important component. That's obviously related to liquidity. The ability to maintain and grow equity, and also the ability to absorb short-term financial shocks. So let's talk about risk balancing from a short-term perspective. Here we're focusing on liquidity and also thinking about business risk along with liquidity. And so liquidity is just the ability of a farm business to meet financial obligations as they come due in the short term without disrupting the normal operations of the business. I'll show you some trends in liquidity for the U.S. here in a couple slides. We have a couple measures that we use quite a bit to look at liquidity. I think one of these is better than the other. I might surprise some people by which ratio I choose amongst these two, but I have some reasons for saying that. The two ratios are working capital to gross revenue, and so working capital is current assets minus current liabilities, and so how big is our working capital in relationship to gross revenue? And then the current ratio, which has been around for a long time, current assets divided by current liabilities. I actually prefer using the current ratio. A lot of lenders in the U.S. and farmers, for that matter, like using the first one, working capital to gross revenue. The problem with the first measure is it really depends a little bit on what's happening to gross revenue. And so what's happening in the United States, for example, is gross revenue has been coming down. And that makes this ratio larger, keeping everything else constant. Well, that's, to me, doesn't necessarily make any sense. And so to me, that ratio has a problem because gross revenue is changing from one year to the next. Now, some people will look at working capital to the total expense ratio. It doesn't quite have as big a problem looking at that ratio over time, but it still has that issue that total expenses and gross revenue are changing over time. And so I actually prefer to use the current ratio myself. In the U.S., we actually have a liquidity crisis right now. I don't think it's quite as extreme in Canada. If that's not the case, please correct me. But because of the exchange rate, the changes have been in your favor to some extent. I think the liquidity crisis is a bigger problem in the U.S. But from 2007 to 2013, we really built up liquidity. I'll show you this in a couple graphs here in a minute or two. But we really built up liquidity that period of time. Since 2014, we've been drawing down that liquidity. The reason we've been drawing it down, of course, is crop and livestock prices. This is worldwide. They adjust downward much faster than our ability to reduce costs. And so as a result, margins have tightened and liquidity is being drawn down. That's why we have liquidity. But it does take quite a bit of liquidity when you're looking at we're starting on about 5th year of having fairly tight margins. That can draw down your liquidity quite a bit when you're dealing with 5 years in a row where your margins are fairly tight. And so because of that, farms need to be very cautious that management strategies do not increase business risk. For example, most of the farms in the U.S. are not investing a lot of money in machinery, or they're being much more cautious in buying land, and that's because they're trying to balance this fact that we have liquidity issues. We're trying to balance that by not doing anything on the business side that's going to increase our risk exposure. And so this is a graph just for White County, Indiana. It's a case form that I use just to illustrate that gross revenues have come down substantially compared to expenses. I've got this on a per acre basis, but that doesn't matter. I just wanted to show the trend. And so we have been able to reduce expenses somewhat. It's not like we have no ability to reduce expenses, but it's been very difficult to reduce those rapidly in response to a much lower gross revenue situation. This is an example of a corn-soybean rotation. So our liquidity benchmarks that I typically talk about or typically use are working capital to value farm production ratio above 35% and a current ratio above 2. And so I'm going to talk a little bit about an article that I wrote with Alan Featherstone at Kansas State University last summer. We're going to update this article in the next month or two, and I'll post it on the Center for Commercial Agriculture website if you'd like to look at an updated version. But this article looked at liquidity for Kansas Farm Management Association farms that had 20 years of continuous data from 1996 to 2015. And so these were the same farms over that 20-year period. We're going to take a look at their liquidity. It's primarily crop farms and crop beef farms. And so we can see working capital value farm production. The average went up. That's because value farm production, which is another measure for gross revenue, went down. And so again, it looks rather odd because of what's happening to gross revenue on these farms in recent years. And so like you indicated earlier, I like the current ratio. The current ratio is still relatively strong. If we look at the average current ratio for these farms in 2015, 2016 would be a little bit lower, but nevertheless, it's still relatively strong from an average standpoint. Notice the average current ratio over this time period is 3.5. That in itself is interesting, but we really want to look at is how many farms have current ratio below 2, and what's the trend over time. Just to get this idea of what's happening to liquidity and what are some things we need to think about from the business standpoint when we have tighter liquidity. And so we can look at this with both measures. Looking at working capital value farm production thresholds, for example, 35% is the benchmark that I typically use, but lenders that I talk to have a red flag when this working capital to value farm production drops below 20%. In that situation, you're really not talking about being able to have much liquidity to cover a downfall more than a year or so. And so 20% or below is getting quite low. And you can see here in the last 2-3 years, the percentage of farms with a ratio below 20% has increased rather dramatically. And so it was from about 6% all the way to about 12% in 2015. I'm expecting this to continue to increase when we add the 2016 data here in the next month or two. And so these farms where this working capital value farm production threshold is getting worse are going to have to really think very strong about what they're doing on the business side to balance the fact that our liquidity is much tighter. And so that's the whole notion here, or the concept that I want to focus on during this webinar is they're going to really need to take a strong look at what they're doing from a marketing plan standpoint, what they're doing from a crop insurance standpoint, what they're doing from an enterprise mix standpoint, to make sure that they don't increase their financial risk because they're doing something on the business side. Looking at this from a current ratio standpoint, the number of farms with a current ratio below 2 is rather dramatic. Dramatic increase since 2012. It's approaching 20% now. So a fairly large percentage of the farms in Kansas have a current ratio below 2, and essentially a ratio below 1 means you're illiquid. Your current assets can't cover your current liabilities. That's a very difficult situation, obviously, and there's getting to be over 5% of the farms that are in this category. And so again, this liquidity situation is becoming a crisis for a larger percentage of farms, and so those farms have to be very, very careful what they do on the business side in order to balance the fact that liquidity has worsened. So summary points: despite a large drop in net farm income in 2015, most Kansas farms in this association still have very solid liquidity positions on the average. But again, there is an increasing number of farms that are below the critical liquidity thresholds, and that's increasing and likely to increase in 2016 and likely to also increase in 2017. And so, the bottom line here is these farms really have to do a better job on the business side of trying to protect themselves if they're going to make it here in the next 2 to 3 years. Just a kind of a side note here: liquidity was related to debt to asset ratio. The farms with very high solvency also tend to be fairly liquid. I don't think that's any big surprise, and certainly. There was also a relationship with labor efficiency. If you do a better job with labor efficiency, you're more liquid. I think that makes sense. Now let's go to solvency. And so we're going to look at risk balancing from more of a long-term perspective. We typically look at financial risk from a long-term perspective using the debt to asset ratio. And the benchmark I use is 40%. Some people use 50%. I typically don't benchmark this across farms, but in my experience, if the debt to asset ratio gets above 40%, we really need to start asking, why is it above 40%? Is it because of aggressive growth, or is it is it personality of the farm? They would like to take on higher debt levels so they can grow rapidly. They've brought somebody into business, for example, or is it because we haven't been able to pay our bills? And a lot of times, high debt to asset ratios are on farms that have not been very profitable over time. That's obviously a big problem. And so once the debt to asset ratio gets above 40%, we need to increase monitoring and really figure out why the debt to asset ratio is as high as it is. So this leads us to another article I wanted to talk a little bit about, balancing business and financial risk. This is an article that I wrote for the Center for Commercial Agriculture website. And what I wanted to do here is just use some case farms to examine the relationship between business, financial, and total risk, and to illustrate what happens in these risks when interest rates and leverage change. And so we're seeing interest rates are likely to increase in the U.S. here in the next. They've already increased somewhat, but they're likely to continue to increase the next 2 to 3 years. This is adding financial risk. And then also because of the fact that that our margins are pretty tight. We're also seeing leverage change. We're seeing farms, for example, that are adding debt to the operation by using land that was already paid for as collateral. That's an example that we're seeing repeat itself quite often, and so leverage is also changing. So I'll take a look at here with these case farms what happens to financial risk and total risk as leverage increases. And again, I'm focusing on the debt to asset ratio. So I don't want to get into the weeds here, but let's say we have a case farm that has return on assets of 10%, very profitable, quite profitable. This would certainly be in the top quartile if you're talking Kansas farms or Illinois farms and the farm management associations. And for all these farms, the base farm and the case of higher interest rate and higher leverage, we're going to assume that return on assets is the same, and the coefficient of variation is also the same, and so business risk is the same. That's what that top part of the table is telling us. Measuring business risk with the coefficient of variation, which is standard deviation divided by average. And the interest here, it varies from the base to the higher interest rate case, and so we're going to see what happens to financial risk and total risk, which is a combination of business risk and financial risk, as we increase the interest rate. And in the last column, we're going to see what happens to financial risk and business risk as we increase leverage. Notice there I have a rather large increase in leverage from the base in the higher interest rate case to the last column, which I'm calling higher leverage, original name there. So with this profitable farm, TR stands for total risk here, and remember, total risk is the combination of business and financial risk. As the interest rate increased here, it was a fairly large change in the interest rate, 2.5%. We saw total risk is 7.7% higher. Business risk is the same, but this higher financial risk made the total risk go up. Leverage, on the other hand, increased total risk by 16.7%. So total risk is substantially higher under this higher leverage situation. So for this higher leverage farm, they would really need to do a better job than what I'm illustrating here, trying to manage their business risk. They would have to probably have some different strategies in the base farm in order to manage that business risk and to balance this business and financial risk. Now we get to the interesting situation. Let's say the profitability is quite a bit lower. This would be an example of the profitability that we've seen since 2014 in the U.S., or a case where long term we have a farm that's not real profitable. And so in this case, again, I'm assuming the business risk is the same among these farms. I'm just lowering the return on assets. And so notice that I'm not changing the business risk here. Again, the second column, we're increasing the interest rate, and in the third column, I'm increasing leverage. And so let's see what happens in this case when we have higher interest rates and higher leverage. In this case, when we have rather low profitability, the increases in total risk are substantial. The impact of the higher interest rate on total risk is a 20% higher risk. Think of these total risk as kind of an index. 20% higher index of total risk under this change in interest rate. And obviously, because we have higher leverage, we have higher interest payments, and so that makes a lot of sense. It would be a fairly big impact of higher interest rates under this low profitability scenario. However, let's take a look at the increase in leverage. In this case, if we have higher leverage, total risk increases 50%. And so again, it illustrates the importance, if we're going to have higher interest rates, which we are facing in the U.S., and higher leverage, we're going to have to do something on the business side to control risk in order to ensure that our total risk does not increase as much as what I'm showing in this particular diagram. And so the importance of crop insurance, the importance of looking at diversification, the importance in being engaged in production activities that have lower risk. For example, contract production increases dramatically when we see this higher interest rate, higher leverage situation. just comparing farms, just repeating what I've already said, on the lower return, the impact on total risk is much greater. The impact of higher interest rates, higher leverage. So summary points: increasing interest rates and leverage increased financial risk and total risk, making it all the more important to try to control business risk. And so a farm facing more financial risk, which is a very real situation that we're facing right now, may need higher crop insurance coverage levels or consider contract production. Anything they can do to mitigate risk on the business side is going to pay dividends in the current environment. Is there a solvency crisis in the U.S. right now? The short answer is, in general, is no. On average, debt-to-asset ratios for U.S. farms have increased since 2013. However, we were coming from positions that were relatively low starting in 2013. Now, having said that, there is farms. I'm not going to go through some liquidity charts like solvency charts like I showed you for the liquidity situation. There is farms that have high solvency ratios as measured with the debt-to-asset. Or have debt-to-asset ratios above 40%. For these farms, it's increasingly important to try to figure out why. Why is their debt-to-asset ratios so high? Is there anything we can do to try to mitigate these high debt-to-asset ratios? And it makes a lot of difference whether the high debt-to-asset ratio is due to aggressive growth. That's not necessarily a good thing, but maybe they bought a lot of assets and they increased their debt rather dramatically by buying these assets. Is there a way to spin off those assets and reduce debt? Maybe they've added family members. In the U.S., for example, there was quite common for families to add family members from 2007 to 2013 when returns were relatively good. Can those family members stay on the farm? Do they need to have an off-farm job in order to be able to stay on the farm? And so we need to figure out whether these high debt-to-asset ratios are due to aggressive growth. Is there anything we can do to try to mitigate the impact from this aggressive growth that we've seen in the past? That's one thing. If it's due to aggressive growth, that's a problem in itself. Don't get me wrong. But if it's due to inefficiency, either we're using way too much labor. I talked quite a bit about labor benchmarks in the U.S., and one of the ratios that I use for crop farms, for example, is a farm that has labor expense. This would be operator labor and hired labor. That's 20% of value of farm production or gross revenue is inefficient from a labor standpoint. The really efficient farms are much closer to 10%. So labor is making up 10% of the cost structure on these farms. If you look at labor expense, including the operator labor, compared to value of farm production or gross revenue. And so using benchmarks to look at inefficiency is very important. Also capital, how much machinery do we have invested per crop acre? How does that compare to other farms? How many buildings do we have invested per animal unit? If you're looking at livestock, how does that compare to other farms? And so if we're looking at high solvency ratios, we have to look at aggressive growth. We also have to look at inefficiency. And hopefully it's been obvious from my discussion here that farms are in this high solvency situation really have to look at what they're doing from a business standpoint, and the pressure's on. They really have to think about how they can reduce business risk by doing things differently on the farm, because they have to somehow offset the fact that they have very high financial risk compared to most farms. Conversely, if you have a farm that's in very good financial situation from liquidity and solvency standpoint, they have more options when you're looking at business decisions. For example, those kinds of farms, they certainly can look at whether some relatively new endeavors that we're seeing down in the U.S. can be attractive for their farm. I mean, they can look at whether producing organic crops or livestock, or maybe looking at producing specialty crops like waxy corn or processing tomatoes or something like that. Farms with low financial risk really have more options, if you will, to look at some of these other options from a business standpoint. So that's the whole idea here of this risk balancing. As we have high financial risk, we really have to take a look at what we're doing on the business risk standpoint and try to reduce business risk. Conversely, if we have relatively low financial risk, we can take more chances on the business side. So this really impacts our strategy. If you're thinking about this risk balancing equation, it really impacts our strategy, and it makes a lot of difference on whether we're looking at low financial risk as measured with liquidity solvency, or whether we're looking at high financial risk. Another thing I wanted to talk about here, it's not directly related to what we're talking about today, but this is something that I try to include in a lot of my webinars, a lot of my presentations, is we have to do a better job in the farm community of tracing changes in farm net worth. It's quite often, it's very common to use market value balance sheet with lenders and to monitor what's going on farms. And we usually do this by entity and then try to combine them in an aggregate for the entire farm. The problem with the market value balance sheet is obvious. It's really difficult to separate how much value we're adding from retained earnings or retained profits and how much value we've added over time from changing in asset values. And so I'm really preaching that we really need to use market value balance sheets and what I call modified cost balance sheets, so we can really figure out what retained earnings have done over time and separate that out from what's going on with respect to changes in asset values. Our land values have been changing rather dramatically in the U.S. In the last 3 years, land values in Iowa, for example, have dropped 25%. Prior to 3 years ago, land values were increasing rather dramatically in Iowa and across the Corn Belt and the rest of the U.S. If you use a market value balance sheet, it looked like net worth was increasing dramatically. That's great. That's all fine and dandy, but we really needed to figure out, even in those years, whether the balance sheet was changing because of increasing land values, or the balance sheet was changing, or in addition was changing because of increasing retained earnings. And so it's become increasingly important to try to separate out retained earning changes from changes in asset values. So with that, I'm going to open it up for questions. I wanted to leave plenty of time to address questions.
Hey, Michael, thanks very much. All totally pertinent to what we talk about here at Farm Management Canada, and I know a lot of our registrants, people watching today, it's obviously piqued their curiosity as well. I'm going to hog the spotlight and ask you a question, basically because it's very timely. As you know, succession, or as you use the term, transition. We have an annual conference here, and it's it is the overarching theme this year. You mentioned it, but could you expand on how transition/succession could be a risk?
Definitely. One of the things that we do when we talk about transitioning, and I'm sure you do that too, is a feasibility test. And so we talk to people about whether it's feasible to add a family member. And a rule of thumb that I use quite often is this is a minimum figure. It takes at least $500,000 per worker on a farm in order to be able to pay for the worker. And workers here are operators, they're hired labor. Part-time labor is a part-time worker, if you will, but it takes $500,000 per worker, and so we go through the math a little bit. Is this farm big enough from a gross revenue standpoint, regardless of where the gross revenues come from? Is this farm big enough from a gross revenue standpoint that they can actually pay an additional person? If they're not, they've increased their risk rather dramatically, because their risk of being able to make to meet cash flow needs went up dramatically. They're going to run into liquidity issues rather quickly. Usually, when they run into liquidity issues, what do? They add long-term debt. And it also increases the pressure on farms to add debt quickly. And so it really, by adding a person that you really can't afford to add, increases risk from a liquidity standpoint because it tightens up the cash flow more than it probably should, but it also puts undue pressure, I think, on solvency. Solvency is going to go up when you add a family member, but you certainly don't want it to have to go up because the farm wasn't big enough in the first place to add that family member. So hopefully that's addressed your question.
Yeah, for sure. Thank you very much. And before I get to Barbara's question, I just want to remind everybody of the poll at the end. We'd appreciate if you stuck around and took the few seconds to fill that out. Barbara has asked, with respect to the debt to asset ratio, are you using ACB or FMV for the assets?
Oh, yeah. When I talk about debt to asset ratio of 40%, I'm using market value. So so the machinery and equipment and the land would be the big one here, would be valued at market.
Super, thanks, Michael. John asks, do you have any benchmark suggestions for cost of equipment or buildings for crop or livestock operations?
Yes, definitely. On crop, in terms of, we look at crop investment as crop investment per acre. I've actually wrote some publications on this for the Center for Commercial Agriculture website and also for Farm Doc Daily, which is a daily newsletter coming out of the University of Illinois. I write for that periodically. The benchmark we use, and this is in U.S. dollars, but I don't know why you couldn't come up with something similar with using Canadian dollars. The benchmark we use is $500 crop investment in machinery and equipment per acre. There's a lot of farms that have a higher benchmark than $500 right now, but that's the benchmark that we've been using for quite some time. As it gets higher than $500, it really increases your machinery cost per acre and makes it much more difficult to meet cash flow needs. With that ratio, you have to be a little bit careful because you wouldn't want someone to have a really low ratio either because that's not sustainable long term. Those that have very low crop investment per acre are usually farms that are transitioning out of agriculture. And so the $500 per acre is a farm that's going to be in production agriculture for 5 to 10 years, if not longer.
Michael,
buildings is a little bit harder to come up with a number for that. That's very species dependent. So I typically don't have benchmarks, rules of thumb benchmarks for buildings.
John has followed up. Is that $500 per acre based on FMV of machinery or book cost?
Yeah, that's a very good question. That's actually, that $500 per acre actually should be based on more of a book value. I don't think for machinery, in the U.S. anyway, maybe it would from Canada. In the U.S., it wouldn't make a lot of difference whether you use market value or book value for machinery, but the $500 that I'm referring to is used by farm management associations, and they typically use book value when they look at that number.
So when you were talking
also, a follow-up point on that, when you're looking at machinery costs, there's also benchmarks for machinery cost per acre. In the U.S., that benchmark would be machinery costs would include repairs, fuel, depreciation on equipment, interest on equipment. We have a benchmark for that of $120 per acre. That would be using book depreciation rather than tax depreciation.
Michael, when you were talking about management strategies to decrease or just not increase risk, you gave the example of machinery. Could you give a couple other examples?
Strategies not to increase risk. The big one that we've seen in the last couple decades in livestock is the contract production. In Indiana, for example, we have a lot of our crop producers also have contracts to produce swine. That obviously reduces their risk rather dramatically, and allows them to take on, because they've reduced the risk on a whole farm perspective, they can actually take on more risk on the crop side. These farms that have these contracts, and quite often do. Let me give you some specific examples. It's easier for them to look at buying land, for example, because they have risk controlled through that contract to some extent. And so buying machinery is an easier thing for them to look at because they have that contract. Another thing that's becoming somewhat more common, I think it's going to increase rather dramatically in the next 10 years down here, is having contracts to produce crops. Now, I'm not talking about fixed payment contracts. I don't think those are coming anytime soon to crops like we have for livestock, for example, swine. But we are seeing more cases where we have contracts to produce crops where they receive a price that's so much above the price for producing yellow corn. That is also risk reducing because typically their margin is higher when they're producing this specialty crop, or example in Indiana would be waxy corn and popcorn. That would be a couple of examples. If you're producing waxy corn and popcorn and you're making more profitability, that increases your flexibility on what you can do with respect to financial risk. And so that this whole idea of risk balancing, if you have a contract and you're getting higher margins through that contract, that really allows you to do some other things in your operation and not worry quite as much about how risky these other things are in your operation. So does that help?
Absolutely, yeah. Kind of just a very general question. And this may seem very inane and obtuse to begin with, but you use the word efficient and efficiency a few times. I'm just curious if you can clarify in your mind. Obviously, it's a mixture of all these things you've been talking about. What is the perfect efficiency in your opinion?
Oh, that's a good question. It's almost like that question was planted. When I typically look at efficiency, I look at it in a couple different ways, and I look at efficiency through what I call expense ratios. I'm sure you use expense ratios in banks and farms in Canada, just like we do in the U.S. And actually, I look at three different expense ratios, and so bear with me a little bit while I explain these different expense ratios. The first one is to use an expense ratio that excludes all opportunity costs. Opportunity costs are typically associated with owning machinery and equipment, land, and operator labor. And so if you exclude all opportunity costs, what is the expense per dollar of revenue? The long-term benchmark we look at there in the U.S. is 70%. It's more common for people to have something close to 80%. And so when I was talking about the $500,000 per worker, that's assuming that you had an 80% expense ratio excluding opportunity costs. I've also started using expense ratios that include opportunity costs, because these opportunity costs vary tremendously across farms, particularly depending on how labor efficient the farm is, how capital efficient the farm is, and whether they've invested a lot of equity in their capital. So another ratio I use is I add to the expenses a charge for operator labor, but also a charge for owned machinery, just using economic depreciation and an opportunity interest rate, and then also an opportunity charge for land. And so I add all these opportunity charges to the cash expenses, to your traditional expenses, and then I divide that by gross revenue and value of farm production. And long term, that ratio needs to be below 1 or below 100%. And so that's kind of your economic profit threshold. If that ratio is below 1 or below 100%, depending on you want to call it as a ratio or as a percentage, then you're making economic profit. If that ratio is above 1 or above 100%, you are actually making an economic loss long term. And so when I talk about efficiency, cost efficiency, that's what I'm talking about, is these expense ratios. Now, of course, Of course, we also look at technical efficiency ratios, and so looking at crop production yields, looking at productivity for different livestock enterprises. Those are important, but to me, they're secondary. We first look at this expense ratio, and then we try to figure out whether the problems with the expense ratio are related to technical issues. So does that answer your question on efficiency?
Absolutely, and I'll take all the credit. That came from my little brain itself. So we've popped the poll up, and while people are taking the time to do that, if you could give us any sort of final thoughts and maybe a few takeaways, and then we'll wrap it up and do some thank yous.
I think this risk balancing concept is relatively easy to understand. If you have quite a bit of financial risk from a liquidity or solvency standpoint, by definition, you really need to think about your business strategies differently than if you didn't have this high liquidity and solvency risk. And so I think it's kind of a natural thing to think about, and I think farms do this naturally, but sometimes it's helpful to kind of talk through that. If you're going to borrow additional money, what are you going to do on the business side that's going to offset the fact that you're borrowing this additional money? How are we going to balance this business risk and financial risk?
Brilliant. Well, Michael, listen, thanks very much. Hopefully everything south of the border is going well, and that you enjoy your Wednesday. I want to thank again you and RBC for putting us together. So without further ado, from Farm Management Canada in Ottawa, I'm Chris Penton. Thank you very much, Michael. Thank you, RBC. Enjoy your Wednesday afternoon, everybody.
Thank you.